Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Monday, September 29th. The stock market posted its worst one-day percent decline in 21 years after the House of Representatives rejected the $700 billion financial relief plan. Stocks were down 3.5% at 1:30 Eastern Time on news that Wachovia sold its banking operations at fire sale prices, reports that several European financial institutions had to be bailed out, and concerns that the changes made to the financial relief plan over the weekend would limit financial firm participation. The S&P 500 then plummeted to a loss of 8.8% after the House of Representatives rejected the Emergency Economic Stabilization Act by a vote of 228 against it to 205 for it. A total of 218 votes were needed to pass. The act was expected to pass, so the stock market's reaction was decidedly negative on the fear that the economy will suffer if credit markets do not improve. Presumably, Congress will work toward a new plan to ease the financial market turmoil, although it is not clear how long it might take. To be sure, credit markets remain tight. The TED spread, which is the difference between what banks charge each other for 3-month dollar loans and what the U.S. government pays for 3-month loans, rose 63 basis points to 3.55%. That is the highest level since at least 1984 and indicates that banks are reluctant to lend to each other. With regard to Wachovia, Citigroup will pay Wachovia roughly $2.2 billion in stock, which is the equivalent of roughly $1 per Wachovia share, for more than $700 billion of Wachovia's banking operation assets and related liabilities in an FDIC-facilitated transaction. Citi will raise $10 billion in a common stock offering and cut its dividend by 50% to help absorb the acquisition. Wachovia will continue to own brokerage A.G. Edwards and investment management firm Evergreen Investments. Overseas markets also tumbled, with clear signs that the global financial system is strained. 3 European governments bailed out Belgian bank Fortis, the UK nationalized mortgage lender Bradford and Bingley, and Germany's Hypo real estate holding was rescued by a consortium, according to the Wall Street Journal. To help improve dollar liquidity, the Fed coordinated with 9 central banks across the globe to more than double their swap authorization limits to $620 billion. In addition, the Fed is increasing the size of its term auction facilities. The moves gave a modest improvement to credit markets, only to be overshadowed later in the day by the rejection of the financial relief plan. Investors rushed to treasuries in a flight to quality bid. The 10-year note rose 2 points to send its yield down to 3.61%, and the 30-year bond rose nearly 4 points to push its yield down to 4.15%. The 1-month Treasury bill fell 5 basis points to yield only 0.05%. Likewise, gold, which is considered a safe haven, rose 3.7% to $915.50 per ounce. Commodities as a whole tumbled 5.9% on global economic concerns. Crude oil futures fell 10.7% to $95.48 per barrel. The Dow, Nasdaq, and S&P 500 fell 7%, 9.1%, and 8.8% respectively, settling at session lows. The Nasdaq and S&P 500's declines were the largest since Black Monday in 1987, while the Dow posted its worst day since the September 11th attacks. All 10 of the economic sectors posted a loss. The worst performing sector, financials, fell 15.9%, while the best performing sector, consumer staples, fell 4.2%. Weakness was broad-based. Declining issues outpaced advancing issues by a whopping 55-to-1 margin on the NYSE. A total of 1.85 billion shares exchanged hands on the NYSE, with volume surging in the final minutes of trade. The S&P 500 is now down 25% year-to-date. I'm Pat O'Hare for Briefing.com. Thanks for listening, and have a good evening.